what's the difference between and using an example between investing using options and investing outright using stocks. Now, I put in this slide because I'm assuming, my assumption is everybody would, most of the audience here would have some form of experience investing in. Okay, because this is probably something that's not too difficult to do. In theory, you can actually close your eyes, anyhow choose a stock, and if your gods favor you, you probably can still get it right. You know, a few months down, the stock price, for whatever reason, that it will just increase, and then you, without yourself knowing why, you can still get capital appreciation. So options, not the same. Don't ever do that at options. Okay, you must invest time and effort to learn about options. You cannot just cover your eyes anyhow, tikam, and hope that and think that your options will still come out working well for you. Now, the difference between stock investing and options investing. When you invest in a stock like Apple, okay, so this info is a little bit outdated. Let's say as of last Monday, is Apple, of course, yesterday it has dropped to 117. As of last Monday, if Apple is trading at $124, if you buy 100 shares of Apple, which is what is the standard contract size, if you buy 100 shares of Apple outright, you're talking about having to cough out $12,440 US in order to buy 100 shares. Now, let's just say you buy Apple because you are bullish about the stock. You think that end of the year, given a Christmas rally, there's a good chance that the Apple stock will rise, will appreciate. And if it really, at the end of the year, if it does rise $150 per share, and you sell it off to pocket the capital gains, your ROI, based on ROI calculation, you are actually getting about 21% ROI, which is pretty good. Now let's look at what happens if I invest using option. Now, remember the call. What is a call depicted by? A call is depicted using a bull, right? Again, if you're someone bullish, and I assume that you want to buy a call contract. Each contract is 100 shares, right? Because you're a buyer, you gotta pay, right? What is the cost to you? It's $10 per share. So it's $10 times 100. You are required to fork out $1,000. Please compare this with buying 100 shares of Apple. You are only required to put up $1,000 to buy one call option contract. And because call option prices move in tandem with the underlying stock price, meaning say if Apple share price actually rises, your call option price will also increase. So if let's say you buy at $10 and the end of the year it increases to $25. So what one strategy you can use, you sell away the option contract back to the market, and 25, you sell it back to the market at 25 when you actually bought it at 10. Your ROI, based on ROI calculation, you're actually getting a bigger ROI percentage return. So this is how one of the beauties of option